All right, so we're now into week 9 of the semester, and we're transitioning into the second half course content. In the first half of this semester, we were largely taking up contextual type issues, so broader policy issues. But in this section of the course, we're going to take a closer look at various policies and programs, and we're going to start with one representative social insurance program, and then one representative public assistance program. And so we're going to represent those separate universes of programs. And so we'll start with Social Security. In other words, we're talking about old age survivors, disability insurance. That's the formal name given to our Social Security system, with the acronym being OASDI, of course. And then by way of Social Security, we're talking about, we'll discuss the eligibility requirements. We'll talk about how the benefit is calculated. And then finally, there's often this perception that the system is going broke, that we're not going to have enough to finance the system. And so we'll take a look at that financing challenge and what it'll take to overcome that shortage, that perceived shortage, I should say. And then in the second part of this lecture, we'll take a look at our welfare system. And the formal name given to our welfare system is Temporary Assistance for Needy Families, or TANF is the acronym that we give. And so we'll take a look at just a quick history of our welfare system. We'll take a look at some of the major conditions. Most notably, I want to focus on the major conditions that are required of both states to receive this welfare grant from the federal, this block grant from the federal government, and also at the individual level, and what individuals must do to receive welfare assistance from their respective state governments. First, we start with Social Security, or Title II of the Social Security Act of 1935. Of course, the first name given to our Social Security system was old age insurance, but of course now we've added a survivors component, we've added a disability component to make it what it is today. That's OASDI. And so this is just a quick look at the Social Security Act of 1935, but as it currently stands. And so this structure is going to look very much like the slide that you saw previously in the history lecture. And so in 2015, we're looking at various titles that are collected as part of the Social Security Act. I want to just point out a couple of different sections here. So Title II is, of course, Social Security. That's old age survivors, disability insurance, OASDI we see. And then, of course, Title IVA refers to our welfare system. The very first name was Aid to Dependent Children. And so that name has, of course, changed over time. And the next week, we'll take a look at our public health insurance programs. That's Medicare and Medicaid. Those are four of the more notable titles under the Social Security Act as it currently stands. This is just a quick review of social insurance, and what we mean when we talk about social insurance. We talked about universality, how social insurance programs are potentially available to anyone who's made contributions over their lifetime. Anyone with an earnings history is potentially eligible for social insurance programs. We talked about how social insurance programs are generally financed. We talked about dedicated earmark funding, and then we talked about some private insurance problems, namely adverse selection and moral hazard, that are thought to be overcome by government-sponsored insurance. That is social insurance. Social insurance essentially overcomes these issues of adverse selection and moral hazard. We've talked about those issues before. And so this is just a quick poll of the class. If you're sitting at home, we're just asking you here. This is a poll taken from the New York Times. And so the quick question here is, when you turn 67, and I'm assuming that by the time that you turn 67, I'm thinking about college students, by the time you turn 67, that'll be the retirement age. And so currently the retirement age is 66. I just want to make sure the facts are straight here, but that retirement age, that full retirement age, increases by 2 months every year. It'll reach 67 by the mid-2020s. And so by the time you reach full retirement age, in other words, right, do you think, A, do you think Social Security is not going to be there? Or do you think, B, that your benefit will be probably less than half of what current workers or current retirees receive with a similar earnings history? Do you think it'll be somewhere between 50% to 100% of what current retirees receive? That's answer choice C. Or do you think D? Do you think your Social Security benefit, when you retire, will be comparable to what current retirees receive, those with similar earnings history, that is? The major point of this quick poll is just to point out that when the New York Times conducted this survey, most recipients, or most, I'm sorry, not recipients, but most respondents answered either A or B. So most, especially college students, if you're looking at different demographics, most college students think that that Social Security is not going to be there when they retire. But as we'll discuss shortly, this perception about the Social Security trust funds being exhausted and such is not entirely accurate. And so we'll take a closer look at the end of this lecture at the Social Security financing challenge. So first, just we're going through the mechanics of how Social Security actually operates. We'll look at eligibility, benefits, the benefit structure, and how the benefits are calculated. So first, in the way of eligibility, we note that Social Security is a social insurance program, and by extension, there's a contributory scheme, meaning that you must make required contributions over your lifetime. And so, if we're thinking about what that required contribution is, it's 40 credits worth of contributions. And so those credits refer to quarters in a given year. If you've made contributions as a full-time worker for 40 quarters over your lifetime, which amounts to about 10 years, approximately 10 years of full-time employment and FICA taxes being taken out of your paychecks, then that'll render you eligible for Social Security benefits. And so you can become eligible on the basis of your retirement status. You can become eligible based on disability status, if that should occur. And you can also claim benefits based on survivor status. And so there are different benefit calculations for the different classes of retirees. And so we're going to focus primarily on the retirement benefit and how that eligibility and that benefit, the retirement classification, and how that eligibility and that benefit is calculated. Okay, so there's different different calculations for how the different retirement benefits are calculated. So we're just going to focus on one of those various classes. So I'm talking here about the financing of the Social Security program, and to finance our program, we have something called the Federal Insurance Contributions Act. This was the piece of legislation, the actual piece of legislation that mandated collection of taxes for Social Security purposes and for Medicare purposes. So we noted there's a contribution that's required over your lifetime, and so that the actual amount of that contribution is 6.2% of your earnings. But it's not on all your earnings. You're going to pay 6.2% on earnings up to $118,500. And so this is not just a required contribution on the part of the individual worker, but also the business. And so by 6.2%, we're saying that both the worker and the business will pay 6.2% for total contribution of 12.4% of your earnings. And note that the Medicare tax, the Medicare FICA tax that's collected is not 6.2%. We'll talk about Medicare in more detail next week, but the Medicare tax is 1.45%. So when you hear about the FICA tax, we're talking about a 7.65% tax that's assessed both on the worker and your employer for a total contribution of 15.3% in total. And so just a quick note here, this Medicare tax, we've actually increased the Medicare tax recently for higher earners. So if you're making more than $200,000, if you're a single individual making more than $200,000, you'll pay 2.35% as opposed to 1.45%. All right, another note here. So there's sometimes this conception that Social Security is sort of a government-sponsored individual retirement account, that it's kind of a piggy bank where you're contributing money over your lifetime and then you should get it back when you retire. So that's not actually how the Social Security system, the financing system works. It's a pay-as-you-go system, meaning that the current retirees are receiving their benefits from current workers, right? So if you think about how the system operates, that system depends on how many workers we have at any given point in time in our history. And so that's what we mean when we're talking about a pay-as-you-go system. Current workers are paying for current retirees and their benefits. I'm posing this question somewhat facetiously, but the question here, the basic question here is, how progressive are these taxes? Or on the flip side, how regressive are these taxes? And so recall what we mean when we're talking about progressivity or regressivity. When we're talking about progressive taxes, of course, this is when the rate of tax increases. Regressive, the rate of tax decreases, as income increases. And so if we're assessing the progressivity of the Social Security tax, let's say we're just moving up the income scale or income levels, we have a $30,000 worker, and that worker, we note, is going to pay 6.2% tax, 6.2% tax up to $30,000. So up to that point, we of course have a proportional tax. Doesn't matter if you're at 10,000 or 30,000. It's still 6.2%. Let's go up a little higher here. We'll go up to 118,500 at that maximum taxable earnings amount. And so up to that maximum taxable earnings amount, we still have 6.2%. So if we're classifying the tax structure as being progressive or regressive, we still have a proportional or flat tax up to the maximal taxable earnings amount. But consider someone at a much higher level. Let's say we have a $500,000 worker. So for a $500,000 worker, that person will pay 6.2% once again, but only up to $118,500, at which point there is no additional tax. So on earnings exceeding $118,500, this $500,000 worker is not going to pay anything. And so if we calculate the actual tax rate for this worker, okay, as opposed to the marginal rates, the actual tax rate, 6.2% of $118,500, I'm pointing out the actual amount here. So $7,347 is what the person will actually pay as a percentage of this person's gross earnings of $500,000. So the actual tax rate for the $500,000 worker is 1.47%. It's not 6.2%. And so if we're assessing, again, facetiously, if we're assessing how progressive these taxes are, not progressive at all, right? So we see that the tax rate just declined from 6.2% to 1.47% for the $500,000 worker. And so we note that this is a regressive. We characterize the Social Security tax as a regressive tax structure. All right, so on the benefit side, once again, if we're assessing how beneficial or how it impacts lower income worker versus a higher income worker, let's work through this. And so when the Social Security Administration, this is the government entity that's responsible for administering the program. When the Social Security Administration is calculating your tax, your benefit, your Social Security benefit, what they'll do is they'll take your highest 35 years of earnings. Technically, it's before age 60. So they'll take your highest 35 years of earnings, and they'll try to figure out what's called an average index. I shouldn't say try to figure out, but they'll calculate your average index monthly earnings amount, or the AIME. That's what it's called. This is basically what you used to make over your lifetime on a monthly basis. So what you made per month, basically, is what they're determining. And so there are, of course, 420 months in 35 years. And so once that amount is determined, once that AIME is determined, they'll take the first $856 and they'll give back, in other words, they'll give back 90% at that low level. And then between $856 of your AIME and $5,157, if you made on average $5,157, that difference, right, between $856 and $5,157, you're going to get back 32% of that median level. And then anything over $5,157 in the way of your average index monthly earnings amount, you're going to get back 15%. So you see the different tiers. You get back 90%, 32%, and then 15% of higher level earnings. And so those amounts will get added up to calculate your starting monthly benefit, which is technically called the primary insurance amount, or the PIA. Okay, so that's the basic calculation. So I run through a calculation here. You can follow in your slides. So let's say it was determined by SSA, the Social Security Administration, that you made on average $6,000 per month over your lifetime. And so $6,000, right? The first $856, you're going to get back 90% on the difference between $856 and the next spend point. This should be $856. And so that difference between the first spend point and second spend point is $4,301. And so you're going to get back 32% of that amount. I note the amounts here. And then anything exceeding $5,157 in the way of average indexed earnings, you're going to get back at 15%. And so this person, this person will get back $2,200, almost $2,300. And so someone who, so in short, if you've made about $6,000 over your lifetime, you're going to get back almost $2,300 as an average benefit. As an average Social Security benefit. And so that benefit is going to be adjusted for changes over time. So that starting monthly benefit is going to be adjusted for changes in prices, is what we're noting. Okay, and so note here that there is a cap on your benefit. The cap changes from year to year. That cap for 2015 is $2,663. All right, so taken as a whole. So once again, if we're assessing whether it's more favorable for the lower income worker versus the higher income worker, a broader question. We noted that the tax structure is more favorable for the higher income worker, while the benefit structure, as you saw, is certainly more favorable for the lower income worker. You get back 90% at lower levels versus 15% at higher levels. And so we characterize the benefit structure as being progressive, and the tax structure, once again, as being regressive. And so you can see how or why this program might be popular, might be so popular among both conservatives and liberals, because we're talking about a compromise in the way of the tax structure and the benefit structure to appease both the conservatives and liberals. So I went over this point about adjustment for changes in prices. So for 2016, there was no increase in the consumer price index. The consumer price index is the actual index that's used to see if we should increase the benefit. If the consumer price index, if the CPIW changes from year to year, that is, if average prices increase, then we increase the benefit amount. But apparently, we note here that for 2016, meaning was there a change between 2014 and 15? There was no change in prices, as determined by the Bureau of Labor Statistics at the federal government. And so your benefit level will not be increased at all for 2016. All right, so in the last part of this lecture, we'll talk about some the major policy issue, and that's with respect to financing the Social Security program. And so, but first, I note some criticisms from the left, both from the left and from the right. And by the left and the right, I'm of course referring to political or ideological leanings. And so, from the left, I'm not sure why you would want to criticize a program like Social Security that's quite generous, if you think about it, but. So one of the major criticisms is not really pointed at Social Security per se, but saying that really because of the generosity of Social Security, we've ended up with a two-tiered system of available public programs. You have the Cadillac insurance, right, Social Security for those who have an earnings history, and then we have our welfare system with much lower benefits, sort of a second-class program for those without earnings history. And so really the criticism is pointed more at our welfare system than it is at Social Security. And so these are arguments coming from Linda Gordon in her book called Pitied but Not Emptied. I'm sorry, Pitied but Not Entitled. All right, and then of course most of the criticisms about Social Security, about the program, come from the right. So from the conservative spectrum, or the conservative end of the spectrum. And so we've had some major criticisms in the 1980s through the 1990s. Some of these criticisms or these proposals for revision have been adopted. We did, in fact, adopt the Greenspan Commission, making some adjustments to increase retirement age, for example. And then, of course, we have the more recent Bush administration in the 2000s. This was a more radical proposal where we would have been allowed to take 1/3 of our Social Security contribution, that's 6.2%, and invest it in the stock market. And so that really didn't gain much traction in Congress. But these are some of the criticisms that have been pointed at our Social Security system. All right, so this brings us to the last issue here, and that's with respect to the financing challenge. The crux of the challenge here is that we have a system that we noted before that it's based on pay-as-you-go financing, right? And by pay-as-you-go financing, we noted that the system is dependent on the number of workers that we have at any given point in time. And so if we're looking at those ratios, if we look back to 1950, we had a very robust 16-to-1 ratio of workers to beneficiaries. We had 16 workers for each person receiving benefits under the Social Security program back then. But you see here, by 2010, that number has dwindled down all the way to 2.9-to-1. And so the projection is that by 2035, we're going to be down, we're just going to have fewer and fewer workers per each retiree or beneficiary. We have disabled beneficiaries also, but that ratio is quite low, is a projection, and so we have to do something. We have to do something in the way of our demographics, certainly. That might be one criticism, or one challenge, is to fix this ratio And so the basic challenge is, well, should we do something on the tax side, or should we do something on the spending side? And so there's been some criticism that we're going to start dipping into the Social Security Trust Fund. There were some projections that we would start dipping into the trust fund by 2017, but the last I looked, this is in which we're talking about this week, when I checked the Social Security figures, the Social Security Trust Fund, we're at 769 billion in the way of receipts, in the way of revenues, and we're spending 714 billion. And so those projections from 2010, some recent projections that we'd be dipping into that trust fund, that we'd be spending more than we're taking in, have not come to fruition. We're still taking in more than we're spending. But of course, the challenge still remains, what about long term, right? Is there a risk that we might actually dip into that trust fund, and might we just exhaust that trust fund at some point in time, is the basic challenge. And so there are various strategies that have been proposed. I'm going to let you all take a look in your textbook. Your Donito textbook does a great job of outlining some of the strategies to address this financing challenge between decreasing numbers of workers versus increasing numbers, relatively speaking, increasing numbers of beneficiaries. And so one of the strategies is in the way of reducing the cost of living adjustment by 0.5 percentage point. But of course, this year, we don't have a cost of living adjustment. We noted that the adjustment is 0% to reflect zero change in prices, in average prices currently in the US. And so that's one of the strategies, and you can see that the projections in terms of what we would fix in terms of the challenge, 42%. There are other strategies here. Should we calculate benefits over 40 years as opposed to 35 years so as to dilute the amount of benefits being distributed? Should we increase retirement age? One of the more controversial strategies is in the way of increasing the retirement age to maybe 70. We have advancing technology. We have an aging population. Should we increase that retirement age? Should we lift the cap on the amount of earnings subject to the Social Security tax? We have a $118,500 cap. Should we lift that cap? Is what one of these strategies is discussing. And so I'll let you take a look at your textbook for more detailed discussion about how those different strategies might address this financing challenge. And so that concludes the first part of this lecture. And in the second part of this lecture, we're going to dive into discussing the TANF system, that is our major public assistance program that we have in the US.